Think student loans got cheaper? Think again. Because while everyone's celebrating lower interest rates, the truth is, today's students could end up paying up to 50% more than last year's graduates. And it's all hidden in how the system quietly changed in 2023. If you're studying, have kids at uni, or plan to go soon, this is one video you need to watch to the end. Hit subscribe now so you don't miss money truths that could literally save you thousands. You might be surprised what the real student loan interest rate is right now and how much it actually costs you over time. Because it doesn't just depend on the country you study in, but also when you started university. Let's break it down simply. For most current students in England, Scotland, and Northern Ireland, Wales, we'll get to you, the rate is set at the rate of inflation based on the RPI. It changes every September, following March's inflation figure. For this academic year, that's 3.2%. So if you're an English student who started between 1998 and 2011, or since 2023, or a Scottish or Northern Irish student since 1998, that 3.2% applies to you. But for Welsh students who started since 2012, or English students from 2012 to 2022, it's different. You're on what's called a Plan 2 loan, and while you're studying, your interest is RPI plus 3%. That's 6.2% this year. After you graduate, your rate depends on how much you earn. Under £28,500, you pay just RPI, 3.2%. Over £51,000, it's RPI plus 3%, 6.2%. In between, it's a sliding scale. Now, here's the clever bit of economics. If your loan tracks inflation, there's technically no real interest. Let's say you borrowed enough to fill 500 shopping trolleys with groceries. In future years, prices rise. So the total you owe rises too, but so do wages. So, in real terms, you're paying back the same value you borrowed, about 500 trolleys worth of stuff. That's why economists say inflation-linked loans have no real cost. Your purchasing power stays the same. But Plan 2 borrowers, you're paying above inflation. That's a real cost, because your debt grows faster than your income does. Now for the big twist, the 2023 rule change in England. If you started university in 2023 or later, your interest looks lower, but you'll be repaying for 40 years, not 30. Those who started in 2022 or earlier repay for 30 years, and only start once they earn around £28,500. You start at £25,000. So, older borrowers pay less per year and stop 10 years sooner. Newer ones pay longer, and more of them will actually clear the entire loan, including all that interest. When you do the maths, the 2023 onwards students could pay around 50% more over their lifetime. So yes, the rate is lower, but the deal overall, much worse. The state now pays less, and you foot more of the bill. If you're in Scotland, Wales, or Northern Ireland, you're still on the older terms, shorter repayment, smaller loans, often cheaper tuition. In England, though, the new rules make it far tougher to escape student debt early. So don't be fooled by the headlines. A lower rate doesn't always mean a cheaper loan. Check which plan you're on, and know exactly how long you'll be paying. If you found this breakdown helpful, tap like, hit subscribe, and share it with someone starting uni this year. Because understanding the small print today could save you thousands tomorrow. This is Next Gen Money Savings, making finance make sense.